Hi all, I'm Nick Riley. Thanks for your interest in this video. Just as an overview, the purpose of this video really is to address some of the top of mind concerns regarding the recent layoffs that we've experienced, not only in Microsoft, but many other companies as well. But this video in particular is going to be focusing on benefits as it pertains to Microsoft specifically. So the latter half of the presentation will gear towards general layoffs, but the majority of the beginning of this video will be addressing Microsoft specific benefits. So just a little bit about myself. I've worked as a wealth advisor for the past decade, and I've also worked in big tech companies such as AWS and Salesforce. I'm passionate about modernizing my industry, oftentimes in a disruptive way, and really big on leveraging technology to provide people with an augmented experience with their finances. So while working in tech, I moonlighted my way into entrepreneurship and started One Day Advice back in 2018, a non-traditional wealth management firm that provides comprehensive wealth advice for high-income earners looking to optimize their wealth around their own lives. So just before I get started, a quick disclaimer: I am an independent registered investment advisor, unaffiliated with any broker dealer, not affiliated with Microsoft directly either. The purpose of this presentation is for educational purposes. And in a group session like this, where many different people will be viewing it, I am not providing personalized financial advice, as everybody's financial situation is unique. At the end of this video, I will provide you some guidance and direction on how you can schedule time with us to get more of a personalized approach to your Microsoft benefits package as it pertains to personal finances. But the important thing is that this is not an official Microsoft event. I am not HR. I don't write the layoff terms and conditions, and recommend that you always refer to your HR department for confirmation of these benefits. So with that being said, let's have let's start the presentation, and feel free to reach out with any questions after the fact at hello@onedayadvice.com. So the agenda for this video is, first of all, specific to Microsoft benefits and how to optimize those with your remaining days prior to your last paycheck. Then we're going to go into more generalized concerns that people have around getting laid off and as it pertains to their personal finances, things that they can plan for and proactively do prior to their last day. And we'll address considerations on reallocating assets and how to plan around a change in income, as well as the impact on taxes that it might have. So what do we know around Microsoft's specific severance and benefits through the layoffs? So essentially, you are given a notification date, and this varies from employee to employee. The most recent one was on March 27th. And depending on your notification period, you have 60 days that is labeled a continuation period, where you are technically still an employee, so you can't get work elsewhere and still qualify for the severance and other benefits, but you will be locked out or no longer have internal access to your Microsoft resources. So, but the 401k match, the ESPP contributions, life insurance, other benefits will continue on through that continuation period. And the way the severance works is that up to L64 employees, you receive 1 week for every 6 months of service. And if you're L65 or above, you receive 2 weeks for every 6 months of service. And this is capped at 39 weeks for either of those options. And the severance payout after termination date is reduced by the 60-day continuation period that I addressed earlier, with a minimum severance payout after termination date of being 1 month. So that is, if you are haven't been there for very long, the minimum severance is 1 month of pay. From a health benefits perspective, COBRA premiums are paid for by Microsoft for 6 months after the termination date. And COBRA, just so you know, can last up to 18 to 36 months. You would have the choice to extend that, but only the first 6 months of that would be paid for by Microsoft directly. And this is ultimately, getting laid off and changing employment is deemed a qualified event from an insurance perspective. So it allows you to shop the private marketplace for other insurance options beyond COBRA. And it also allows you to switch to your spouse's plan if you have one, in order to get onto their plan. So this is technically a qualified event for those purposes. And we'll get into some of the decisions around that later on in this video. With regards to optimizing or maximizing, whatever word you want to use for it, the current benefits, there are limited options given the time frame that you have still at Microsoft. So one being, we really don't want to leave free money on the table. So we want to make sure that we're getting the benefits out of Microsoft that you guys deserve before your final day and before your termination date. So one being your 401k. Obviously, Microsoft's match is 50% up to the pre-tax contribution limit, which is roughly $22,500. And it also allows for a mega backdoor Roth. And that, if you aren't aware, is just after-tax contributions made to your 401k that can then be converted to Roth down the road. And not every employer offers that. So if you are looking to maximize the value from that mega backdoor Roth, it's important to do that now, and because there's no guarantee that that will be offered at other employers as well. So it's important to note too that there won't be any 401k contributions allowed from the severance payout. So it's really only taking into effect the compensation that you receive during your continuation period, or the 60 days after your notification. And you can kind of test your contributions and everything through Fidelity Net Benefits. And I've seen in most cases any changes to that reflect, before your next paycheck, even though it might state on there that it might take a couple pay periods. I've seen that be implemented and reflected much sooner than that. So it's important to at least make those changes as soon as you are committed to those changes inside Fidelity Net Benefits. One thing to be aware of is that you can't max out your 401k at Microsoft and the next employer. So it's not like you can double dip on 401k contributions. You are given a certain allotment on an annualized basis by the IRS. So you can't max out both and double dip in that sense. So something to be mindful of in figuring out whether you want to seek employment right away or take a break from employment, use your severance to satisfy living conditions or living lifestyle needs and all that. The ESPP is another great benefit Microsoft offers, which is essentially a deferral of compensation that is used to then buy company stock in Microsoft. And you can defer up to 15% of your salary, and that equates to a 10% discount at the quarter end on Microsoft stock. So that's that 10% discount. Essentially, it's a free 10% return offered by Microsoft through that ESPP. And it's something that you should be participating in if you can afford the deferral of some of that income. But keep in mind that you can only exercise that ESPP if your continuation period falls during the quarter end, where you can actually use your deferred compensation to buy stock. So something to be aware of when kind of setting what percentage you want to defer in your salary. The RSU component to Microsoft benefits are great. The vesting continues on past your termination date for another 6 months. So it's important to go into your total rewards portal, print out any pending stock compensation, print out that deposit schedule, and make sure that it checks right with what you actually receive. So Microsoft is a big company. Mistakes are not very frequent, but I have seen them done before. So it's important to at least have your own records of what you are entitled to from a stock compensation standpoint, and make sure that lines up with what you actually get. And back to your own records and everything, I think it's important to have your own file in place. Take screenshots wherever you can to give you a good sense of what to expect, and then you can kind of do your own accounting to make sure that you received what was entitled to you. And that is also relevant for determining your accrued vacation time. So the time and reporting TAR, since Microsoft stopped accruing vacation days for employees on the 16th of January 2023, any remaining accrued vacation will be paid out in your April 15th paycheck. So it's important to go through, make sure check that balance, make sure that checks and is equal to what you actually receive on your April 15th paycheck. If not, of course, go to HR and make sure you get that full amount. You can't get 401k contribution match on that. That's just going to be a flat payout on those accrued vacation hours. If you're charitably inclined and take advantage of the Give portal through Microsoft, you can still do that during your continuation period. However, the system access is lost within 1 to 2 weeks of that notification, and elections need to be made prior to that. So if you've already passed that period, it's worth maybe talking to HR, see if they can extend that for you and make those contributions. If not, that may be a missed benefit on your end. The Stay Fit funds is also another use it or lose it type of program within Microsoft. So that is still available during your continuation period as well. Access to that is also lost within 1 to 2 weeks. So make sure to get those reimbursements filed, whether it's for physical fitness, financial fitness, legal fees, kids tutors, and a host of other items. But just make sure to go into your total rewards links for any details around that and submit any outstanding reimbursements prior to you losing access. And just kind of a soft plug for my own business, we do have solutions. If you haven't fulfilled that Stay Fit fund yet, we have solutions in place where we can invoice you, and you can also get reimbursement through Microsoft directly. If you're considering building out a financial plan or having access to a financial advisor or wealth advisor who can look at your situation holistically and help you navigate this next stage after no longer being an employee at Microsoft. Lastly, 2 benefits are at the Avail company store and AirEgg for legal benefits, as well as the Microsoft Alumni Network. So you'll want to likely join that Microsoft Alumni Network. The fees are waived for the first year, so I would suggest signing up. There's a bunch of benefits through there. And then with Avail and AirEgg, make sure to use that up while you have access. And I can't emphasize enough the importance of having an estate plan in place, and that AirEgg program is great from a legal benefits perspective. And if you still can leverage that prior to your last day or your termination date, just getting your updated last testament and will, your power of attorneys, health directives, any trusts that need to be made. It's really important to have that in place in case anything does happen to you. And of course, when you leave Microsoft, you'll have to pay that out of pocket. So you might as well take advantage of that benefit. So that's the end of Microsoft specific benefits. The rest of this presentation is going to be addressing more broader based things to consider when getting laid off as it pertains to your finances. So first topic is life insurance. So you have a group plan through Microsoft, and you may or may not be given the opportunity to move that into a private plan or convert that into a private plan. I know Google has a specific plan provider that you can do that through. I'm not entirely sure if Microsoft has that directly. If they don't, you can go to use a service like policygenius.com that's essentially an online marketplace for life insurance and other types of insurance. The reason I recommend that is because they are able to shop around for the lowest fees. and reduce that cost for you. And it reduces kind of any conflict of interest that a financial advisor might have in saying, oh, you need to get whole life insurance or cash value life insurance or anything else. So in general, I do recommend term insurance because it's the purest form of insurance. You can get the most death benefit, the best bang for your buck, and it is definitely the least expensive option. And I would, as a fair warning, you will likely, because of the layoffs and everything, you will probably be hit up by a lot of different financial advisors. And when they lead with insurance, they're typically an insurance agent compensated through commissions. So that can influence the type of recommendations that they make you go through. So just keep in mind, I used to have my insurance licenses. I no longer have them because I was tired of that conflict of interest, and being able to take a step back, look holistically at someone's situation is really important when it comes to financial advice. So be mindful of what type of an advisor you're working with. And then with regards to healthcare, so I addressed the 6 months paid for COBRA through Microsoft. Other options would include going through a private marketplace. The state of Washington has that. So they have a health plan provider website that you can navigate to. You can also go through your spousal benefits. And it really comes down to whether you want to pay more in premiums in order to have no unpredictable thing occur, or if you plan on having medical costs, it might make sense to have that without the large deductible. But for those of you who are healthy and just want to reduce monthly premium costs, then a high deductible plan might make sense. And that will depend on whether you go through the marketplace. COBRA is going to be a little bit more expensive, but when you have that first 6 months paid for by Microsoft, that makes up for it. And that, depending on whether you want to go straight into another job or not, that might cover that gap of not being insured. Other financial considerations are with regards to financing. So once you no longer receive a paycheck, you won't have a proof of income from a lending standpoint. So if you were looking at buying a home, buying an investment property, taking out a HELOC or like a home equity line of credit to make some improvements to your home while you're in between jobs, if you're looking for any sort of refinancing or financing options, it's best to be proactive on that while you still are receiving a paycheck and have proof of income. Depending on the lender, they may be asking you about whether you're laid off or not. Always be honest. You don't want to commit financing fraud, so you don't want that on your record. But it is important to be proactive on that. If you were wanting to have an extra buffer of financing between you and your life savings. Other things to consider are really what's next for you. Are there things you'd like to do? Are there the things that you want to get out of life that you can do now while you're healthy? Is starting a business something you've always thought about? This might be a good time to pursue things like that and to really rethink your career. Ask yourself, is it serving you? I think it's a great chance, receiving that severance and having the ability to take a step back and really think for you and your family, what is best and what will best serve you. And that might mean taking a hit in income to pursue something you're passionate about. It might mean going back and pursuing further education. So there's a lot of options for you, but I have one story I just want to share with you all. I had a performance coach that I worked with for a number of years, and he was a executive in the media industry, and he took a break from work for quite a while, actually, during his peak earning years, late 40s, early 50s timeframe. And he just wanted to spend time with his kids and his family. And of course, he had a wonderful time. People were asking him, why are you doing it right now? You had a great position. You're making a lot of money. And he just wanted to prioritize his kids. And fast forward, he went back to his career and everything. And he ended up passing away 2 weeks, sorry, before his 65th birthday. And that really hit home to me, because if we follow the traditional advice of working until you're age 65 and retire at that point in time, it's a reminder that that is not a guarantee that it will ever happen. And it's a reminder that you should pursue what is meaningful for you now. And it's okay to prioritize your now rather than your future. Of course, a lot of emphasis is put towards delayed gratification and moving everything into a future retirement date where you will then have the freedom to do what you want. But I think it is really important to take a step back and think about the things that you would regret not doing now with your health. And if you ever were in a situation where you didn't have the opportunity to turn 65 and retire and live retirement years, then you'll be glad that you had done it earlier in life. So that to me really hit home for me as far as I'm concerned with kind of managing the balance between now and the future. I think it is important to prioritize both. Next, we're going to talk about just the considerations on reallocating assets. So, of course, this is a major life event for many of you going through, and some of you might not have other income for the household. So there are a lot of things to consider when reallocating current resources and current assets that you have. So number one really is cash planning. You want to be sure to increase your emergency fund. So if you have automated contributions to investment accounts or whatnot, it may be worthwhile just temporarily pausing that in order to kind of beef up your cash savings that will essentially provide a buffer between you and having to tap into your invested assets if you go through a prolonged period without income or transition into another job. So with that cash on hand, it's important to have that at least working for you at the most that it can. So a high yield savings account is going to be a great option for you. And really right now, as of April, the going rate for a real high yield savings account is roughly 4 to 5%. I have solutions in place that are right within that 4.5% mark. If you want to reach out to me, there's no cost to that at all. That's just an access thing that I provide to my clients and my extended network. But there are other great options out there as well with other traditional banks. Main thing is you don't want to have your cash just sitting in a checking account or an older savings account that kicks out no interest. I-bonds are also a great option. And the downside to those are that they're not liquid. They're harder to purchase. You have to purchase those directly through Treasury Direct, which is the United States Treasury Direct website. And there are it's great interest, obviously, but there are some stipulations on how long you have to have that locked up. So they aren't very liquid, and you can't put a whole lot of money in there either. So that's something to be mindful of when considering options. If you're wanting slightly more flexibility in how you kind of manage your interest, you could build a ladder of CDs or bonds. So CDs are certificates of deposit. You could stagger those 6 months out, 1 year, 2 years, you name it. And essentially that will provide you, better interest rate on some of that cash that you don't need for the short term. And I personally, most of the time, I lean towards high yield savings accounts with clients because I like the optionality that it provides of being able to quickly convert that to liquid cash that can be used towards spending, other investments, and other opportunities. You also want to use this time to increase your taxable savings. I think a lot of the many tech employees that I work with, one great aspect to them is that they're very diligent in putting away money towards their retirement accounts. They're maxing out their 401k, they're maxing out all these other benefits. And what I find is when it comes time to buying a home or buying an investment property, investing in small businesses, participating in private equity or venture capital, you can't do that as easily with real estate, you're not going to buy physical real estate inside your IRA. You might be able to invest in real estate in that. But ultimately, by increasing your taxable savings, that allows you to invest in a lot of these other alternative assets that will give you better opportunity to perhaps have a greater long-term return. So it's okay to take a step back from retirement contributions as long as you're still not leaving free money on the table with your employer over the continuation period. But for that next phase of kind of financial planning for you and your household, it's important to increase your taxable savings. Speaking of taxable savings, that can be also done through selling your Microsoft stock. So one of the most common questions we get at One Day Advice and just in the wealth management industry is how much to sell, how much to keep. And of course, it depends on everyone's personal situation. But I think being no longer an employee at Microsoft, that gives you the flexibility to either remove all of that stock, diversify that away, and kind of reduce that concentration risk, which concentration can make billionaires. You look at Warren Buffett and others, where they made a large majority of their wealth by concentrating assets. However, it is risky. And if you want to have more predictable growth in your portfolio, it will be better to diversify that out and reduce some of that risk. So when it comes to diversifying your assets, you don't want to over diversify and you don't want to under diversify. It's kind of a Goldilocks approach of finding what is just right, because if you over diversify, you can really reduce the long-term returns in your assets, and if you under or not diversify enough, you risk a lot of the volatility in that portfolio to make it a lot less predictable over the long haul, to be able to use some of those assets towards more predictable future living costs, such as buying a home or other things like that. When it comes to rolling your 401k into an IRA, this is kind of a hot topic amongst many people getting laid off. And of course, you're going to be hit up by a lot of financial advisors, probably on LinkedIn and other means, where they might recommend that you roll over your 401k to your IRA. And I would just warn you that there is a conflict of interest in the industry today with regards to that, because many advisors can't charge on assets that are in a 401k. They can only charge on assets that they directly manage themselves. So not to say that it's a bad piece of advice. It can definitely make sense in most situations. But before jumping to conclusion on that, you want to make sure that you're talking to an advisor who is serving your best interest and walking you through other options as well. And there are advisors out there, such as myself, or people that operate on a fee-only basis, that can work with you on a full range of assets based on your net worth, your investable assets, your goals, and all that. It's important to be talking to the right type of financial advisor. So lastly, on asset allocation, the main considerations you want to make are going to be based around your goals. So what you have to plan for financially, whether you are putting kids through college, you want to buy a new home, you want to buy an investment property or a second home, you want to travel the world for 6 months, whatnot, your asset allocation is going to be determined by those upcoming financial goals. It's also going to be determined by your stage in life, and that will determine how aggressive you are in certain allocations, as well as your risk tolerance. So some people just have a better stomach suitable for lots of volatility, lots of ups and downs in the market, and others just want more consistent returns. There's ways to allocate your money to accommodate for full end of the spectrum, either direction. And asset allocation considerations, lastly, also include the available liquidity that you have. So if you have a lot of cash on hand, that allows you to be more aggressive with the money you don't need in the near term. And keep in mind that the more you're able to not need liquidity, the more you're able to invest for the long term, the more the market will actually pay you for that investment over the long haul. So it is important to have enough cash on hand, but also have enough of a portfolio that's invested in growth and appreciating oriented investments, as well as income producing investments. So next, on how to plan around the change in income. So I think this is a very relevant piece for everyone, whether you're getting laid off or not. And the reason being, tech compensation has been on the rise for a long period of time. And I think with the current economic environment, these layoffs and the rise of AI and other technologies, it's causing a reset of expectations around compensation. And not to say that you can expect a pay cut. In many cases, you might still be making more money continually. But I think a lot of tech employees were so used to being heavily compensated, and they reflected that through the way that they spend too. So I think it's really important to take a step back, knowing that you are being laid off. You're no longer going to have that income coming in, and there's no guarantee you have a job to replace that with. You really need to be mindful of how your spending has maybe crept upward with that rising income over the last few years. So it's important to adjust your emergency fund to make sure you have enough cash on hand. And if need be, raise additional cash. I recommend kind of just raising cash on a periodic basis rather than all at once. That way you can still participate in investments that are taking place, but you have a plan in place to increase that cash position over time to fund future lifestyle and living needs. So I think spending is very important to address when you're addressing a change in income. And there's many different ways that you can do this, but I think in essence, the data won't lie. If you have your credit card statements, if you have bank statements, or if you've used some sort of tracking software to track your expenses, it's important to separate all those from income, expenses, and transfers. Transfers being from one account to another, from an investment account to checking or vice versa. You don't want to double count those transfers as income or expenses. So making sure that you have a clean data set to understand what you spend on a monthly basis. And ideally, I think having at least 6 months worth of living expenses will give you a good sense of what you spend on average. The easiest approach, if you don't want to go through all the data, I think a lot of us can be very realistic with ourselves and just ask the question, I probably spend too much on blank. And I think many of us will know exactly what we probably spend too much on and what we can cut back on. So that might be something that an exercise you want to do, whether you ask yourself, be honest with yourself, figure out where you might spend too much, where you can cut back, or, go into your actual data of historical expenses and find out what it is there that you can remove. And to help you remove certain expenses through this process, I like to refer to a dieting analogy. So when it comes to nutrition, there's good fat and bad fat. And bad fat, like potato chips or whatnot, they drain you of energy and have a short-term benefit. So they might give you an energy spike right away, but overall, you're going to have a down period following that short energy spike. And whereas on the other end, good fat gives you sustainable energy and focus. So you think of avocados and other types of good fat that are good for you. So when it comes to spending, there's also good fat and bad fat. There's ways to spend money to get that quick dopamine fix, only to deplete you of energy long term. And there's also, on the other end of the spectrum, ways to spend your money that will give you longer term meaning, fulfillment, and happiness too. So it's important to really spend more in areas that provide you that meaning, fulfillment, and happiness, and spend less in areas that give you that quick dopamine kick. And that will help you kind of live a more overall well-being type of lifestyle. And you can build your own decision framework around, what spending is bad fat, what spending is good fat. That's something for you to decide. And when it comes to hacks around spending, so if you just want to try a few different things while you're going through a period of no income, I find when purchasing large items, implementing a 48-hour rule is really helpful. So if you really want, say, a new away luggage or whatnot, you can pause that, wait for a couple days, 3 days, and if you decide after that period of time that you still want that product and you want to go through that purchase, then go for it. In many cases, you might find that you don't need it, but it's just an extra little buffer between you and impulse spending. Another thing that you can do is go through a spending cleanse or detox. So you can remove really all of the expenses in your life that are non-fixed and non-essential, and then slowly add back the things that you miss the most. And I think this is a great thing to do on a periodic basis anyways. But with the layoff and expectations around reduced income moving forward, I think this is a great exercise to be able to do for yourself financially, so you can set aside more of your life savings towards other financial related goals. Lastly, let's address the taxes situation. So the impact on your taxes is relatively minimal. We do get questions on this, like how is the severance tax and all that. It really depends on how you specify your withholding. So if you had 20% withholding from each of your paychecks previously, that will continue. And I don't necessarily recommend moving that up or down. If you plan on not working for the remaining amount of the year, you might be safe to reduce that withholding. That way you have more take-home pay. Just keep in mind that any shortage in taxes owed come April of next year, you'll still have to pay that back, and there will be IRS penalties assessed based on the timing of that income reported. So, and on the flip side, if you wanted to increase your withholding, you run a risk of being owed taxes back come April, and that's essentially a free short-term loan to the IRS, which many of you probably wouldn't recommend anyways. But there are ways to reduce your overall taxes. So things to think about are a contribution to an IRA. Just be mindful of any income limitations for the Roth and the pre-tax traditional IRA. You can still contribute towards your HSA, which is a tax deduction as well for your health savings account if you qualify for one through a high deductible plan. You may also consider making charitable contributions to reduce your taxes, or you can maybe start a business. And once you have a business, there's a lot of creative ways that you can reduce your taxes as well in a legal way. And that can be done through short-term rental properties, real estate investments, all that, or just even a consulting business. Maybe you have a background that's in demand. Maybe you can write certain code that would be helpful for many organizations on a consulting basis. Then that could be a consideration to make in maybe reducing your taxes over time. The last thing with regards to taxes I think is really important is around Roth conversions. So in any given year, you're allowed to convert pre-tax contributions from your IRA or your 401k, if it's a past 401k, that is, and you can convert that into Roth. And you do pay income tax on that full conversion because you're going from pre-tax money to post-tax money. So it's oftentimes best to be doing Roth conversions during periods or years that you have lower income. So for those of you who are considering not going back to work for an extended period of time and just taking a break, then this year might be a great year to consider taking a Roth conversion, as long as it doesn't bump you up into a higher tax bracket. So that's something that we typically strategize around at the end of year for clients to determine when it makes sense to convert some of those assets to Roth, because the benefit of Roth is that you will never pay taxes on that again. So depending on your age and how your assets are allocated, it's great to have Roth savings that can continue to grow tax-free for the rest of your life. So that is a wrap on this presentation. I know we covered a lot of material, much of which is directly impacting you as a Microsoft employee, but also things to consider when prior to your termination date at Microsoft. So I want you to know that if you want personalized guidance tailored to your unique financial situation, we do have a team of advisors at One Day Advice to speak with, including myself. And you can reach out to us at onedayadvice.com or email us at hello@onedayadvice.com, and we'll get back to you right away. We'll provide a scheduling link for you to meet with us. And we would love to be able to offer you at least a free Q&A session, so you can schedule 15 to 30 minutes of our time to provide you personal recommendations. But if you're considering more of a holistic plan around your finances and you think it's a good time through the layoffs to really consider a financial plan, that is what we do for a large majority of our clients, is really develop in-depth, broad-based, holistic financial plans that incorporate their goals, their priorities, both short-term and long-term, and craft strategies to take your existing assets and future assets to be able to fund your lifestyle, fund those goals, and really live a more fulfilling life, knowing that you have the confidence that you are reaching your goals. So if you still have the Stay Fit funds available to be utilized, obviously use that towards your physical health and mental health first. But if there is any remaining, feel free to email us, and we have specific solutions in place to be able to help you get reimbursed through Microsoft for that. So that being said, that's the whole presentation. Hopefully this was valuable to you, and don't hesitate to reach out with any specific questions that you might have. Thank you.